So now it is the time for us to step into the practical world and start analyzing the financials of our company with the soft drinks. So we'll be performing the trend analysis, creating the forecast. We'll be comparing the forecast with the actuals. We'll also be creating reports on the rolling forecast. We'll do everything, right? Now, since it's a made up company, we may not have the financials. So let's do one thing. Let's pull up the financials of an actual soft drink company and we'll assume that these are the financials of our company with the financials, with the soft drinks. So let's go to screener.com. We can pick the company known as Varun Beverages. So Varun Beverage is has been associated with PepsiCo since 1990s. It's a key player in beverage industry. It's one of the largest franchisee of PepsiCo in the world. So the company produces and distributes a wide range of carbonated soft drinks, non-carbonated drinks, and packaged water sold under the trademark owned by Pepsi. So we'll go to the profit and loss. We'll copy all of it. Maybe expenses if we want to uh, expand. I don't think we need sales growth, getting profit, other income if we want to expand. Yeah. So let's now copy this data till here and paste it. So this is our income statement. Let's format this little properly. We don't need these many fancy colors. Maybe reduce the font size and change the font as well. So yeah, this largely looks good. Perfect. Now we'll go on and copy the balance sheet. Borrowings will expand, other liabilities we are expanding, fixed assets we are expanding, other assets also let's expand, and yeah, I think this should be okay. Then let's copy this data. We'll paste it over here, just bring it in the proper format. And files, yeah, the colors, give the heading, this is balance sheet. Then let's copy the cash flows. I'll expand the cash flow, then copy it. All the way. All right. So now we have all the three financial statements of our company with the financials ready with us. Just to remind you, these are the actual financials of Varun Beverages. We are just assuming for the purpose of our training that these are the financials of our company with the financials. Let's start the financial analysis or the trend analysis for this. So now, so now that we have the financials of our company ready, let's start analyzing them. So we'll go to a separate sheet and we'll start performing the historical analysis. Let's compare this. So we are going to do a 10-year comparison. Normally, the comparison of the past couple of years is okay, but since we have the data with us, let's do a comprehensive trend analysis of past 10 years. So we'll start by the sales growth. So we are going to see at what rate the company is growing. You go to the sales of the current month, divide it with the sales of the previous month, and then do a -1. So this would give you the number which, when expressed in percentages, would give you the growth. So as compared to 2013, the sales has grown 18.3%. Now let's assess whether this growth is consistent or not. So I'll copy the formula all the way to the right and maybe zoom in a bit for your benefit. And yeah, so you see my sale have grown considerably, but then there have also been years where I see the growth not being that consistent. In fact, I see a negative growth. Let's color it with this one possibly. Okay, this one, right? But yeah, on an average, my growth has been around 29%. So yeah, around 20 to 30% has been my growth. If I take the most recent data of past 4 years, my average sales has been 33%, which is a good news. Let's try and understand what caused these sale to dip in these years. For these years, we don't know. Maybe the company was facing some challenge, but this we all know that this is the COVID year, so this is kind of an outlier. So while performing any data analysis, any trend analysis, you should know what's the outlier that you should exclude from your analysis. Overall, the sales growth looks consistent to me, and I'm okay. All right. So then from sales growth, let's move on to comparing the operating margin growth from this sale. If my sale is growing, ideally my operating margin should also grow either by the same proportion or by the higher proportion. So let's examine whether my operating margin is growing or not. This is my operating profit. It's already given at the bottom, but just to explain you, I'll do a manual calculation. Works the same way. Current year divided by previous year -1. It gives me the number which I can drag my formula all the way to the right. I can then express it in the form of a decimal. Let's do one decimal place. So again, you see that my operating profit margin is growing pretty much in the same proportion as the sale in most of the years. Yeah, if it's falling, it's falling. It is also falling at the same proportion. So this is the good news. Barring few exception years, I think my operating profit margin growth is also fine. Let's also examine the growth of net profit, because this is ultimately the profit that you will be getting. So now let's assess the net profit as well, if it's growing at the same rate or not. We'll use the same formula. This is our net profit divided by previous year's net profit -1. Copy this formula all the way to the right. convert it in the form of percentage. Yeah. Unfortunately, my net profit clearly indicates that it's not growing well. It's not growing in the way I want it to be. Okay. Because for the first 3 years, I had loss. You can clearly see my net profit is in negative. But since it was the start of the business, you have many gestational cost. So that's kind of understandable. I would only worry if this loss uh, persist. I see another loss, but again, that's in COVID period, so that's excusable. Overall, my profit margin, my net profit margin also looks pretty well. In fact, it looks drastically well in some of the years and pretty much, in line with whatever I'm selling, whatever I am earning as an operating margin. So again, this looks well. So this is again, if you are studying any company, you can make use of an analysis like this just to assess how well or how good or uh, how bad that company is performing. So from all the P&L analysis, we'll move on to something known as maybe a combined analysis. So we'll start with fixed asset turnover. If you are not already aware of this ratio, let me put it down for you, the formula. The formula is simply sales divided by fixed assets. So what this ratio denotes is for every rupee or for every dollar that you invest in the business as fixed assets, how much of a sale that rupee is generating. So basically, whenever you start a business, you borrow the funds or you put in your own money. And how do you use that fund? You use that fund to buy or create fixed assets. And then you use those fixed assets uh, to make products which is then sold in the market, which helps you earn revenue, right? So essentially, this is ratio is telling that for every dollar or for every rupee that's invested in the business, how much fixed assets, how much sales are we getting? So let's apply this formula. Where is our sales? This is our sales. And where is our fixed assets? It should be in the balance sheet. Mm, yeah, so these are our fixed assets. The amount is given over here. Thankfully, I don't need to do a sum total over here. I'll just take this formula and copy it all the way to the right. Okay. So you see, I am getting almost the same uh, as I invested. So I say if I invest one, I am getting a sale of 1.1, 1.2, 1.1, 1.1.0. Throughout 2020, I was not getting as much as I would have wanted. So my fixed assets are not generating enough sale to recover their cost, right? But after 2020, in the recovery years, my fixed asset turnover has been good. How? Because it's in the range of an average 1.7. So if I've invested $1 in the business or 1 rupee in the business, I'm able to earn an average of 1.7 in the last 4 years, which is a good news for me. All right. So this is your fixed asset turnover ratio. Then we move on to another ratio. Let's do net working capital. So you all know working capital. That is working current assets minus current liabilities. Net working capital ratio is pretty much the same. The only difference being you subtract the uh, liquid assets. So you don't consider cash or cash equivalents in net working capital. All right. So net working capital is simply current assets divided by current liabilities. So let's see if we have current assets in our balance sheet laid out properly. Yeah, so we have other assets which we can classify as current assets. This one divided by the current liabilities, which are this one, right? Now, ideally, an ideal net working capital ratio is 2. So your current assets should be twice your current liabilities. Obviously, I mean, it differs with across industries and across companies, but as a general rule, it should be around 2. So I'll even if I assess this company by that thumb rule, it kinds of does not passes, but then again you see in the recent years, in the past 3 years, you see that we have started doing well as a company. So our average is 1.9, which is near to 2. So anything between 1.5 to 2 as net working capital looks good. All right. We'll also uh, assess in terms of net working capital divided by sales. So I'll just see how does this ratio flares as compared to the sales that I am making. Express this in the form of percentage. Okay, not usable. Let's delete it for now. Now let's uh, perform an analysis with some other days, debtor days. So what does debtor days tells me? It tells me that on an average, how many days it takes for me to realize my money. If I am raising an invoice to someone, that person is my trade receivable, that person is my debtor. So then, in how many days is he paying? There can be another scenario. See, a normal invoice payment period is 30 days, but that does not mean you always get your money averaging 30 days. It can be lower, it can be higher. So then again, we can assess basis that criteria also, that whether it comes more or less than 30 days. So all right, so we have the formula for debtor days. It's a Many people get confused. The formula is average debtor divided by sales into 365. All right. Now, the area where people get confused is why is how all of a sudden we have 365. In some cases, it is 30 days also. So it's hard to remember. It's hard to understand this. See, the simple thumb rule is when you calculate the average debtor, how are you calculating the averages? Average is obviously calculated by two or more numbers. So in our case, we take an average by the end of the period and the balance at the beginning of the period. Say for example, our trade receivable balance. Let's see how much does the balance sheet shows. Yeah. So this is our trade receivable balance. At the end of the year 2013, yeah, 2013, the balance was 65. And at the end of the year 2014, the balance is 97. We can assume this as the beginning of the year balance and this as the end of the year balance. So if we start calculating average, what was my average debtor throughout the year, right? Why are we calculating average? Simply because we don't know how much debtors we have generated throughout the year. This was the balance at the beginning of the year. This was the balance at the end of the year. So we don't really know how much sale have we made on credit. So what we'll do is we just take an average of the beginning and the ending balance. We then divide this by sales. So let's do that. Let's take the average debtors. This, okay. and then we copy it all the way to the right. We then divide this by sales of my current year, for which I am calculating the ratio, right? I'm calculating the ratio for 2014. Now, why divided by sales? Simply because how your debtor is getting generated. How do you, how did the debtor came into existence in first place? You made a sale to someone, you issued invoice. It can be the sale of services, it can be the sale of products, anything. You made a sale, you issued the invoice, and then you had the debtor in place. Now you need to know how, what is the average uh, 1 rupee sale, how much of a debtor is being generated. So let's again try and understand this with the help of an example. Say you made a sale of what's our number over here? Yeah, 2500 in a year, right? Now that 2500 gives you an average debtor of this much, 81. That means out of the total sale that you have made throughout the year, you were 81 were the credit sale, right? So you're just trying and identify the percentage of the credit sale in the overall sale. I know these are all not the real numbers, and the real numbers may be completely different from what we are calculating, but then this still gives you a sense of how your numbers are going. Okay, so this is my average debtor, means simple the credit sales I have made in the year, and this is the total sales. So what I'm trying to do is the portion of credit sale in the total sale, and this balance has come after, in a period, in a time span of total 365 days, 1 year, because I'm calculating the sale of the entire 1 year. I am calculating the average of 2013 to 2014, which is again 1 year. So then I'll multiply this number with 365. This gives me an average of 11 days. Okay, I just copy this formula all the way to the right just to ascertain, yeah, how many days does it take for me to recover money from my debtors. This is certainly a very good number. My debtors are paying me back within 10 to 11 days. In fact, very recently my number has jumped up. So maybe something can be done about it, because ideally this number should reduce with time, or at least stay consistent. You cannot reduce number and then have it increasing back. The lower this number is, the more profitable for you, because it improves your liquidity. It makes sure that your money comes back to you on time. All right. So this is my average debtor days. On the same principle, we calculate something known as inventory days. So what is inventory days? Let's try and understand this. Inventory days is average inventory divided by sales into 365. So what this denotes? So basically, what is inventory? What is when you're showing inventory in your P&L, or your when you're showing inventory in your balance sheet, what does that denote? That denotes your unsold inventory, which is lying there, right? So you must have made a sale of 2500 in the year 2014, but still you have some unsold portion left, which is here. 289 is your unsold inventory. So on an average, what's your average inventory? So this is the year end picture, but that does not take into account the total year picture. On an average, what was your unsold part of your total sales, right? Or the, yeah. So what's the part of inventory that you could not sell for whatever reason? So that's how we calculate the average of these numbers, we divide it by sale of the year for which we are doing the analysis, and then we multiply it by 365. We come up with something like this, which are these many days. So, what does this denote? This denotes that on an average, my inventory lies with me for these these many days. As soon as my inventory is produced, as soon as my product is manufactured, it takes 39 days on an average. 39 days, or if I take the average of 10 years, it takes 43.4 days for it for it to get sold in the market and ultimately get my inventories zeroed out. This number, uh, just by looking at this number, it is difficult to tell if it's a good number or it's a bad number. What I can tell you is, ideally, this number should be reducing with time, which it is not. From 39, I have come to 45. And even if I take the most current data, yes, this still looks fine. I'm gradually, very slowly decreasing this number, but then this should be decreasing at a much faster rate. Okay, so average inventory divided by sales into 365 is the formula for inventory days. It denotes the average number of days uh, your inventory takes to get sold in the market. And just as we calculated the debtor days, which denotes how many days does it take for us to recover money from the debtors, let's also calculate something known as creditor days. So creditor days, just like the debtor days, it denotes how much time does it take for us to pay money to our creditors. Ideally, we would want this time to be as stretched as possible. Why? Simply because you'll enjoy the benefit of liquidity, you'll earn interest on the money that you have not paid, and thereby, your ultimately your liquidity would improve. All right, so let's calculate this. Let's see, it should come less than our average debtor days. So average creditor is yeah, trade payables, this divided by again sales. Ideally, this should be purchase, because you only get you only a creditor is born only when you are purchasing something. Just like in case of debtor, a debtor is born when you make a sale, a creditor is born when you make a purchase. But here we may not have the purchase. We can take the cost of goods sold, uh, which again we don't have. So we'll play safe. We'll just take the sales for now, right? Multiply it by 365, and then these are our numbers. All right. What if we would have taken the cost? We don't have the cost of goods sold, but just just to try, let's take the expenses, assuming this is my COGS. It's not, but just assuming, right? So yeah, this number comes higher. So let's go by sales for now, and I can clearly see that this number is higher than my debtor days. So this clearly denotes that I am recovering money from my debtors in an average of 10 days, whereas I'm paying my creditors in an average of nearly more than double number of days, which is 21.7. So I'm for surely enjoying the benefit of liquidity. I'm earning more interest on the money that I have, which is a good news, which is a good thing. All right. We now move on to the debt to capital ratio. The formula is debt divided by capital, as the name suggests. The ratio will go to the borrowings, which is there in our balance sheet. Yeah, here. So this is the sum total of all the borrowings, all the long-term borrowings that we have, and then we will divide it by our share capital plus the borrowing. So borrowing divided by the total share capital that we have. It comes to 95%. Now, what does this denote? This denote that of the total funds that we have available as capital, 95% of it is from the debt. So ideally, this should reduce over time. In an ideal corporate setup, we don't recommend having zero debt. In personal finance, we do like a situation where we don't have any loans with us and we continue to lead a worry-free life. However, in corporate setup, some amount of debt is recommended simply because debt is one of the viable sources of the funds. All right. So while I would like the debt to have some share in my capital, I don't want this to be a substantial share. And I can see this is reducing over time, which is a good news. All right. So after the debt to capital ratio, I now move on to the cash flow analysis. So let's start from cash flow from operations. In fact, we'll analyze all three together. So cash flow from operation activities, cash flow from investing activities, and cash flow from financing activities. It should be there in our cash flow statement. Let's scroll down. This is cash flow from operations. This is cash flow from investing activities, and this is cash flow from financing activities. Copy this through 2024. Let's first analyze the cash flow from operations activity. Now, what is cash flow from operations? What does this denote? This denote the cash that has come to us strictly from our core business. A business might earn cash from investments also, from selling of stock also, selling of fixed assets also, from borrowing also. But the cash flow from operations denote only that part of cash which has come from our core business activities. So in an ideal world, I would expect this cash to increase over time, and I would also want this to be in line with the profit that I'm earning. So if the profit that I'm earning is growing, I would expect the cash flow from operations also to grow. Otherwise, it would suggest that whatever profit I'm making, most of it is from the credit sale. And credit sale, in case of credit sale, there is always a risk of recovery. All right. But in this case, I see that the cash flow from operations is growing at a good pace with time. This formula over here denotes the percentage growth, and yeah, it's growing well over time. Okay. I can also compare it with the net profit that I'm earning. So let me link it. I have added a row for net profit. This is just to make a comparison of how much of a net profit that I'm earning and how much of the cash flow that I have from this. I carry my formula. I did the linking from the net profit, and then I carried it all the way to 2024, and I see that it's growing at the same rate. Okay, so my net profit is also growing, and my growth of cash flow from operations is also pretty much consistent with my net profit growth. Maybe here there's something to be concerned about because my net profit has increased substantially, but it's not reflecting in my cash flow from operations. But overall, this paints a good picture. Now let's also have a look at the cash flow from investing activities. So this is my cash flow from investing activities, and you can see all of these amounts are in minus. So this denotes that I am investing in my fixed assets. I have spent money to buy fixed assets. If I scroll down to this section over here, it clearly tells me that I have purchased fixed assets. I also sold, so possibly I sold some of my old assets and I'm buying new assets, which is a good news because if I keep buying good new assets, that means I'm investing in the new technology, and these assets would in turn help me create better product and have more sales, and more sales means more profit. Then let's move on to the cash flow from financing activities. So cash flow from financing activities, again, I see a massive jump over here. This section over here, it gives me the detail of the cash flow from financing activity. So this is my proceeds from share. I recently issued my shares, and that is the reason I have got huge cash flow. I repaid my borrowings, so my loans have reduced. I also bought little more funds from the market. So I also paid. At the same time I'm borrowing for my business needs. I'm also issuing my shares and getting money from the public, which I have been the external borrowings I have been doing consistently. I'm borrowing funds, but at the same time I'm also repaying my money, my debt. So which is a good thing. Now let's move on to another analysis that I'd like to do, which is return on capital employed. So what this denotes is my net profit. Yeah, so let's calculate return on capital employed. There's one more thing which I wanted to tell you is if you just want to see growth, you can also calculate something known as cumulative cash flow from operations and compare it with your cumulative net profit. It essentially gives you the same picture. The only thing is uh, you don't have to sort of do a manual calculation of the growth in that sense. So I'll show you how. So I go to the cash flow from operations section. This is my cash flow from operations. This is my cash flow from operations for from 2014, and then I add my cash flow from operations from 2015. It's in the percentage format, so I better bring it in the number format. And then I add the cash flow from operations from 2016. I carry this formula throughout 2024. Okay, so this clearly shows a decent growth rate. It's cumulative. I can then compare it with my net profit, which is in my income statement. So again, this can be another method of seeing the growth of your net cash flow and net profit, or whatever number you want to analyze. Now let's come back to return on capital employed. So what is return on capital employed? It's simply checking whether the return I'm getting on my total capital that I've invested in the business is correct or not, is desired or not. Ideally, it should be more than my cost of capital, right? So whatever I'm paying to, I'm paying as an interest against my capital. In fact, basically, the weighted average cost of capital, my return should be more than that. How do I calculate my return? It should be operating profit before tax. Yeah, so this is my profit before tax, because tax is something I cannot control. So I'll take this and then calculate it. In fact, I should not even take this because this takes into account the exceptional items also. You see the exceptional item over here. So this won't paint a good picture. I take the operating profit and then I divide it by my total capital that I've invested in the business, which is this plus my borrowings. Put all of these in brackets and express this in the form of percentages. Currently, it is showing 14% in 2014. Let's see if it's increasing. Yes, my operating profit is increasing. In fact, if I see the last 3-4 year numbers after COVID, it is giving me a result of how much? Let's see. Yeah, 27%, which is a good, decent rate of return. Because nowadays, if you borrow funds from the bank, the most expensive maybe in the form of 13-14% if it's in if it's a government bank, if it's an established bank, unless it's a private institution. So the rate of interest that I may be paying would not be more than 14%, whereas the business is giving me a return of 27%. The other thing that I'd like to calculate is return on my equity. This is essentially my own capital. So this does not include the borrowings or the reserves, right? This is strictly my own equity. So I just take operating profit divided by the equity capital. Again, I see the return over here is very good, right? So my business is in safe hands. So this is all we have as historical analysis. So what we essentially did over here is we took the 10 years data of any company. In this case, it was, I assume this to be my company, and did a historical analysis of the entire company just to gain the business understanding. Different people have different perspective behind this traditional this analysis. Some, they would want to invest in a particular business and hence they would want to analyze it. Others may just want to audit it. That's the reason they may be doing it. In case of FP&A, we want to do this analysis because we want to understand more about the business, its growth, so that we can make an informed projection. So our uh, ultimate purpose over here is to make the accurate prediction, and that is the reason we did this analysis. So whenever we will start projecting, we'll keep these things in mind. So for example, we know if my sales it is growing at a particular rate, I would ensure that whatever I'm projecting should also grow at the same rate. So if I know that my sale is growing at the rate of 33% from last 4 years, my next year's projection should be based on this number. All right. So I'll request you to visit the website screener.com and download the financials of any company that you prefer, that you wish to analyze, and perform the similar analysis of the company of your choice. Make your own observations, and yeah, while you also do that, let me share one more thing. This right here provides a generic guidance on how do you do the historical analysis. What are the criterion that you should be considering? So, for example, the gross margin should not be less than 10%. So these are all the red flags. Your revenue growth rate, if it is less than 2%, then there's something wrong with the company. So all the pointers mentioned over on this should act as a red flag to you while you analyze any company. So, for example, your EBITDA margin is less than 3%, your net margin is less than 1%. So, all these denotes that something is not right with the company if this is the consistent scenario over past few years. Your direct cost is rising faster than sales, your interest coverage ratio is less than 1.5. Similarly, when you are analyzing the balance sheet, if the if there's goodwill in the asset, which is more than 30% of the total asset value, it is something to be concerned about. If your debt to equity ratio, that in our case was something around 1.5, if in your case, whatever analysis, whatever numbers you're analyzing, if your debt to equity ratio is more than 4, then it is something to be concerned about. Similarly, receivable, they are rising faster than sales. Like I mentioned during our analysis, if we are making more credit sales, then we are at risk. If our inventory is rising faster than profits, if our asset turnover ratio is less than 0.5, if your current assets is lower than current liabilities, my quick ratio is less than 0.3. Similarly, from the cash flow statement, if I'm paying the compensation, the stock-based compensation. So basically, I'm paying the employees from my in the form of shares, and that compensation is more than 20%. That denotes that I don't have the money to pay the employees, right? My capital expenditure is more than 40%, or I have negative cash flow from operating activities. My free cash flow is declining. My free cash flow is lower than the net income. We also compared our cash flow from operations from the net income. Similarly, my cash flow to debt is less than 0.1. My operating cash flow is less than 5%. So then obviously these are all the red flags that one should be concerned about. So these are basis the generic and observations of the financial statements across industry. Obviously, when you perform the actual analysis, you also need to consider the industry, the stage at which your company is, if it's an established company, if it's a new company, all those things. So it is this sort of referral thing is only given to you for the reference purpose. It should not be considered as definite or accurate, or for every financial analysis this should hold good. It's just a referral kind of thing that I'm giving you. All right. So do perform your financial analysis, and yep, all the best. In the next session, we'll be seeing more about the variance analysis and other aspects of forecasting. Thank you. And yeah, while you also do that, let me share one more thing.